The Hidden Wealth Tutorial Series. Keep more, live well, leave more. Simply, safely, and effectively. Legacy banking in a nutshell. To begin, let's acknowledge the driving force in our financial decisions. We have wants and needs to fulfill 24/7 over our entire lives, and the money supply needed to do this is finite. Our wants and needs compete for available dollars. We then make compromises in our choices, leaving us vulnerable to unplanned life events. We stretch dollars with debt and take on risk in the hope of making up for it. The banking financial industry offers an array of products and services we use to fulfill those wants and needs. They bring more costs, taxes, penalties, interest costs, fees, and market downturns. These costs further reduce our money supply and must be overcome before our savings and investments make a dime of real gain. This adds pressure to cut corners and take on more risk. There is an alternative: legacy banking. It is a lifetime economic acceleration process designed to replenish money supply by recouping costs, capital expenses, taxes, financing, and investing costs, and earn interest and dividends on all of it with uninterrupted compounding, no tax, and no down years. You keep more of your money and more of what you earn on your money. We will lay it all out for you for your evaluation. Frederick Bastiat, 630-1801 to 1224-1850. Frederick Bastiat was a renowned French economist with great influence on Austrian economic theory, whose principles are the foundation of infinite banking concepts, what we simply call legacy banking. Recognizing that financial actions have economic reactions, which create reactionary costs, Frederick Bastiat was an early teacher of seeing the unseen. Now, we must see and account for the reactions to properly evaluate our actions. A common reactionary cost is opportunity cost. And when we experience a cost, we also experience the lost opportunity for the spent money to earn money for us forever. The lost growth is an added cost. Now, we don't get a bill for it. It doesn't appear on statements, yet it is a wealth-changing cost that grows over time, taking away from the benefit we hope to obtain by taking the action. The banking financial industry does not acknowledge this. Why? Telling customers that loan interest costs have added opportunity costs is bad for business. Telling customers that taxes and fees paid on savings and investment have the added cost of lost growth on the taxes and fees paid reduces the perception of value. Telling them that market down years have the added cost of lost growth on the reduced account value affects buying decisions. So, it is ignored. As a result, the financial advisors they train, as well as their customers, are largely left unaware of its negative financial impact. Nevertheless, unseen and unaccounted for costs impact everything we do financially. How it affects us depends on how we pay for things we buy, how we save and invest, and how we insure ourselves and our things. These are things we can control. Legacy banking is the only known way to control economic reactions to work in our favor. For our financial decisions to work and be efficient, they must be based on financial fact. Are they? When we're told a loan rate is 4% per year, we think the cost is 4% per year. However, a 4% 5-year car loan has a true average cost of 9.44% per year. 4% home equity and student loans have an actual annual loan cost of 46.2% per year over the first 5 years of the loan payment period. The true costs are multiples of the rate. Why? Loans are amortized, loaded with upfront interest costs. We see the payment amount, but we don't see the interest costs within the payment, as shown in the amortization schedule. Conventional wisdom tells us that paying cash is a no-cost way to finance our major purchases. Time value of money calculators prove differently. Why? When we account for all the interest we won't earn on that money forever by giving up our valuable hard-earned capital, we can then see the high opportunity cost of paying cash. Now, these costs reduce our wealth even when we don't see an account for them, even when we don't see how to recoup them, and even when our income level may hide the effects of the loss. They are happening to us now, behind the scene. If we're told the market averages, say 10%, we think we'll get 10%. We don't. We haven't accounted for investment costs, fees, taxes, and down years, plus opportunity costs, the lost growth on these costs. If we got 10% after average cost, we'd net 5.28%. Now, when buying term life insurance and investing the difference, it's 4.78% or less. Investment companies do not disclose this. So, without seeing it, we end up badly upside down, paying 9 to 46% interest on our debt while netting 4.78% from a high average return. The bottom line, the banking financial industry leads us to lock up our money in 401k type plans and other savings and investments, while they make a killing on both sides of our dollars. Would we make the same decisions knowing this? Applying proven economic principles to our actions makes everything we do financially work better. For example, a 0% car loan is promoted as a no-cost loan. So let's apply the opportunity cost principle and look at legacy banking in a nutshell. Conventional bank versus My Legacy Bank. How a $25,000 0% 5-year conventional bank car loan compares to a legacy bank loan. A $25,000 loan is taken to buy a car. The payments are made from income, either way. Let's follow them over the 5-year loan. With our income, at 0%, I pay $416.67 a month for 60 months. After 60 months, $25,000 and all its growth from day one and on into forever is gone at my cost. At 8%, I pay $506.91 per month for 55.6 months. After 55.6 months, $28,185 is recouped into my own legacy bank, plus the earned interest and dividends, giving me uninterrupted growth from day one and on into the future. For a payment difference of $90.24 per month, I have a wealth difference of $55,414 in just 5 years, plus interest and dividends. That's a rate of return on the $90.24 monthly over 74.6% net, no tax. In comparison, the average 401k earns 4.3% after fees and down year costs. After a modest 20% state and federal tax rate, it nets 3.4%. And with both loans at 8%, making the same payment creates a wealth difference of over $60,829 in 5 years and growing. A few additional notes. 8% is the prime new car loan rate at the time of this writing. Paid policy loan interest is credited against the loan balance. So, making the same payment, the legacy bank loan is paid off sooner, a savings of $2,211. Now, your capital is gone forever, or it is recouped with its growth never skipping a beat. Legacy banking gives you that choice. It's simple. Be your own banker, do what the conventional banks would require of you, and you will prosper by keeping and compounding the interest and the principal you would pay to banks for cars, vacations, credit card debt, business expenses, all major expenses, recouping your principal, interest, and the growth on all of it. Before we move on, let's be clear. When I finance my car with a conventional bank, every penny of the conventional bank or credit union loan payment, plus all the future growth on that money, goes into their bank. If I get a 4% 5-year car loan, my cost is the principal plus 9.44% average interest per year, plus opportunity cost, the growth I will never earn on all the principal and interest I pay forever. This pushes the actual cost of the 4% loan to over 14% per year. And when I finance my car with my own legacy bank, I recoup my money. Every policy loan payment I make, principal plus interest, is credited back into my cash value in my legacy bank. My policy loan payments are just like savings deposits. I recoup the principal and the interest I would have paid to their bank. Plus, I earn interest and dividends on it, which recoups the opportunity costs I would have lost on all of it. It's my legacy bank. I own it. So I earn what their bank would have earned on that loan, 9.44% plus the ongoing recouped opportunity costs with no tax or fees. If I used a conventional loan while holding a 401k with average earnings, I'd be about triple upside down on my car financing alone. Now, let's review our car purchase financing options. First, we examine a 4% savings account withdrawal. I withdraw $25,000 and pay cash. My 5-year result is a negative $30,416. My capital and all its earnings go to the bank. Next, a 4% savings account withdrawal and refill. I withdraw $25,000 and refill at $416.67 a month for 60 months. My 5-year result, a positive $27,144, plus taxable future interest. My capital is recouped, subject to taxation and interrupted compounding. Now we examine a conventional bank 0% car loan. I borrow $25,000 and repay at $416.67 for 60 months. My 5-year result, a negative $27,144. My capital and all its earnings go to the bank. Finally, we review a legacy banking policy loan. I borrow $25,000 and repay at $506.91 for 55.6 months. My 5-year result, a positive $30,414.60, plus untaxed, uninterrupted interest and dividends earnings from day one on into the future. And I have the saved payments totaling $2,211. My capital and all its earnings is recouped without tax or interruption. At the time of this writing, about 1.1% of all car loans are 0% interest. The prime car loan rate for preferred borrowers is 8%, a true cost of 18.88%. Now, we set the legacy banking loan payment using the being a good banker concept at the prime rate amount to maximize performance. Legacy banking can be used to recoup principal and interest on all major expenses, including cars, credit card debt, vacations, home maintenance, business expenses, student loans, and health care. The legacy banking policy loan payments are credited directly to the policy cash values, like making savings deposits, and may be reused immediately over and over again to maximize financial performance. Financial security and growing personal wealth starts with keeping more of our money and more of what we earn on our money. That is what happens when we recognize the side effects of our financial actions, what causes them, and apply sound and proven fundamentals to make them work for us instead of against us. That is what legacy banking does. Bottom line, our investing results don't stand alone in a corner somewhere, unaffected by everything else we're doing. They are integrated into everything we do financially, a part of what we call our personal economy. Now, we all have one. Applying cost accounting to our personal economy actions, that is, subtracting the total of our financial and investing costs from the total of our savings and investment gains, after taxes, fees, and down-year costs, is the true indicator of how well we are doing. Why? Running our personal economy is the same as running a business. Profit and loss statements reveal financial truth. The total of savings and investing profits must first overcome the total of financial and investing costs before we enjoy a profit. Savings and investing gains may offset some of our interest cost, but can't possibly make up for the lost growth on the principal we spend as well. To do that, the costs must be recouped to grow for us. Legacy banking does that. Legacy banking is the only known way to recoup the principal we pay, the interest we pay, and the growth we lose on the principal and interest we pay with cash and bank financing. It gives us a running head start to keep and enjoy what our savings and investments do achieve for us, for a more comfortable and worry-free future lifestyle. What do you think? Would you like to see how having your own legacy bank would work for you, personally? In about 15 minutes, our tutorial, Building Your Own Legacy Bank, will show you how to build your own legacy bank and how to use it effectively for the rest of your life in all phases of life. To recoup your financial, investing, and opportunity costs, turning those costs into growing personal wealth. To provide a lifetime retirement income without tax. To provide a powerhouse of guaranteed death benefit leverage for additional tax-free benefits and income. And, ultimately, leave a legacy without tax. All by taking charge of your cash flow, its actions and reactions. Just drop us an email with your questions or to arrange a time to see it. Thank you.